right, let's take a couple of minutes and look at different types of ratio analysis that we can do. And one of the starting points for this analysis is determining whether or not a company is going to be a going concern. Is it going to exist in the near future? Is it going to be able to pay its bills and obligations? And so we can first start with the liquidity ratios. Those are going to tell us whether or not a business can pay its bills and how quickly those assets can be converted into cash. And the way that we can analyze that is by looking at net working capital, current ratio, quick ratio, and the cash conversion cycle. So let's look at those. Alright, so start here by working capital, which is defined as current assets minus current liabilities, and it's critical for all types of businesses. So positive working capital means the company will have enough assets converted into cash within the next year to pay its obligations. Again, very simple calculation. Current assets divided by current liabilities. Current ratio is probably the most significant measure of a company's ability to pay its current obligations. And that's just taking current assets divided by current liabilities. In this particular example, the ratio is 1.55 to 1. That means they have $1.55 in current assets to pay every dollar in current liabilities. A higher number here is going to be better. I've seen recommendations anywhere from 2 to 1 to 1.5 to 1. So again, a company needs to make sure they have more current assets than they have in current liabilities. Those are debt obligations that are going to be due during the current year. An even more stringent test than the current ratio is what we call the acid test ratio. And the way we do this is we calculate the ratio by dividing what we call quick assets by current liabilities. And quick assets include cash, marketable securities, accounts receivable, and those are assets that can be quickly converted into cash. We're going to throw out all the things like maybe say inventory and supplies and prepaids. We're only going to focus on those items that can be quickly converted. And in this particular ratio, you see it drops now to 1.19 to 1. And again, we're looking for a ratio of at least 1 to 1. We need $1 in quick assets to cover every dollar in current liabilities. So in this case, they have $1.19 in quick assets to cover $1 in current liabilities. Let's look at the cash conversion cycle. This measures the time it takes a company to sell its inventory, collect its receivables, minus the time it takes it to pay its accounts payable. So we take our days sales and inventory, add the receivable collection period, subtract the accounts payable payment period, and that's going to give us our cash conversion cycle. Now we may need to go back and revisit what each one of those ratios are as well. Okay, moving on. So the income statement tells the analyst if, how, and when a business is earning its net income or loss. Analysts look at the notes and follow the financial statements to understand how the business is recognizing revenue and expenses. And analysts may want to evaluate the business by using only the income or loss from reoccurring and continuing operations. And if that's the case, we're going to ignore the impact of discontinued or extraordinary items on income. Continuing operations consist of business activities that will likely continue from period to period. So that's going to help us make better prediction about a company's future earnings. Now we can go ahead and look at here the gross profit percentage and the net income percentage to help us calculate if the business is earning a net income or loss and how good they are at doing that. So gross profit percentage is the gross profit. Remember, gross profit is sales minus cost of goods sold, or net sales minus cost of goods sold, divided by sales. So a higher gross profit percentage here is going to give them more monies to pay all of their operating expenses. So we're always looking for a higher gross profit. Net income percentage is net income divided by sales. So that again is expressed as a percentage, and that's going to tell us how good the company is at generating net income, or how much income they generate for every dollar in sales. So perhaps you get a 9% rate here, net income percentage. That means 9 cents of every dollar sold goes as net income. Again, a higher number is going to be better. Then we like to look at where a company is getting its money. Are they financing it, meaning borrowing it from the bank, or are they issuing stock? Both have a certain cost. The cost of debt is going to be interest, and the cost of stockholders' equity is a little bit harder to determine, but it's certainly real because you're giving up a percentage ownership in your business. And owners aren't going to let businesses use their money unless there's some sort of return. So owners definitely require some net income that compensates them for their time and risk. So we can look here and refer to the notes in the financial statements. And then we can see if we want to be able to ascertain if a company is actually able to pay back the debt that it's borrowing. So debt is traditionally less expensive than stockholders' equity, but a business doesn't want too much debt. If it has too much debt, then it can pay back. Obviously, it's going to go out of business. So we want to look at how much debt a business has relative to its stockholders' equity. And then we like to see the changing of the blend of liabilities and stockholders' equity over time. So we can look at the debt ratio and the interest coverage ratio here. Debt ratio is just total liabilities to total assets. This tells us how much of a company's assets are actually financed. And in this particular case, the company has 32.3% of their assets financed. And I would say typically you like to see a lower debt ratio, but some companies tend to run a high debt ratio. They're very good at using that borrowed money to generate income. So you have to be cautious here and maybe look at industry averages and things. And then interest coverage ratio, and this is particularly of interest to long-term creditors who want to make sure the company can meet their periodic interest payments. So we take the net income before interest expense and income taxes and divide it by interest expense. And sometimes we have to add back that interest expense and income taxes to net income to find this number because it is subtracted when we calculate net income. And this particular company earned 11.51 times during the year that they can pay their interest on their debt. Higher number will be better. It means they have a lot of cash or net income coming in to pay their debt as it comes due. Now, how a business uses money to acquire assets is called its investing decision, and businesses invest money in assets such as cash, accounts receivable, inventory, buildings, patents, all kinds of assets. And the goal of the investing decision is to create operating income that adequately rewards lenders and owners for the use of their money. So analysts want to understand the types of assets in which a business invests and how those investments change over time. Then they're going to read the notes to the financial statements to gain insight to the assets such as depreciation assumptions. So now we can look at accounts receivable turnover ratio, inventory turnover ratio, fixed asset turnover, total asset turnover, and return on assets. And let's look at each one of those a little closer. Accounts receivable turnover, we take our sales on account over our average accounts receivable. And you should know by now, average just means beginning plus ending divided by 2. So beginning accounts receivable plus ending accounts receivable divided by 2. This particular turnover comes in at 26.7 times. That means on average, accounts receivable turns over completely about 27 times per year. That gives us a feel for the number of times per year a company can convert its accounts receivable into cash. For any company, the higher the turnover, the faster the cash collection on receivables. So we definitely want a higher number here. And like the receivables turnover, we can calculate inventory turnover. That's taking our cost of goods sold divided by our average inventory. And again, average inventory is beginning inventory plus ending inventory for the period divided by 2. And in this case, inventory gets turned over 12.73 times per year. And that measures the number of times that inventory is sold and replaced during the year. A higher inventory turnover ratio is going to help protect a company from obsolete inventory items. So again, a higher number is going to be better. Fixed asset turnover measures a company's ability to generate sales from fixed assets. Just take your sales divided by the average fixed assets. And average will be, again, beginning plus ending divided by 2. And in this case, a higher will be better. It means they're doing a better job at using the assets they have invested, the fixed assets, to generate sales. And we have an even broader measure here called the asset turnover ratio. That's taking your net sales divided by average total assets. And again, sales divided by average total assets this time compared to fixed assets in the last one. This tells us how good a company or how efficiently management is using the assets available to generate sales. Higher number will be better. How good are they at using all the assets they have invested to generate sales? And then we get return on total assets. And you'll see a little note here. This ratio is generally considered the best overall measure of a company's profitability. And to calculate this ratio, we take net income divided by average total assets for the period, again, beginning plus ending. And so this is going to tell us how good is the company at generating net income with the assets they have invested in the business. Higher number will be better. Okay, analysts want to know if owners are receiving enough benefits to justify their investment in the business. So stockholders invest money in corporations, and corporations use that money to generate net income and eventually pay dividends. But do the net income and dividends reward the stockholders enough for the use of their money over time and for taking risks? So we're going to first, again, look at our statements using vertical and horizontal analysis. And then we want to look at earnings per share, dividends per share, dividend payout ratio, and return on equity here. So basic earnings per share is a pretty commonly used ratio. And what we do is we take our net income minus preferred dividends divided by the number of common shares outstanding. And that will tell us here what the earnings were per share of common stock outstanding. As I mentioned before, it's one of the most widely quoted financial ratios calculated, and it's a measure of a company's ability to produce income for each common share outstanding. As an investor, we want to track this ratio carefully. It's hard to compare this ratio, though, across companies in my mind, because it depends on how many shares of stock a company has outstanding. Obviously, though, a higher number will be better. Dividends per share is the amount of dividend that stockholders receive for each share of common stock they own. We just take the amount of dividends divided by the average number of common shares outstanding, and that gives us dividends per share. Dividend payout ratio is going to tell us what percentage of the net income is paid out in dividends. So we take our dividend amount divided by net income. That gives us our dividend payout ratio. And then return on equity. This is a pretty commonly used ratio as well. Net income divided by average stockholders' equity gives us return on equity. How good is the company at using the assets invested by stockholders to generate net income? Higher number will be better.